While most traders slept through the weekend, the silver market flipped the script overnight, and by the time London opened this morning, the move was already irreversible. They tried everything at once. Margin requirements were raised. Paper shorts flooded the book. The tape was painted red heading into the weekend. For 48 straight hours, the message was clear and relentless: the silver bull run was over. The crash had finally arrived, and anyone still holding was about to pay for it. Then London woke up. As the sun rose over the UK this morning, the smoke cleared and silver wasn't broken. It was standing tall, no press conference, no Federal Reserve announcement, no emergency headline, just raw price action, and not a bounce, an explosion, a massive gap higher that erased the entire sell-off in a single session. That kind of move is not normal. Markets don't behave like that unless something underneath has snapped. This wasn't relief, this was pressure being released. The sound you're hearing is a bear trap closing, hard, on the biggest players in the world. It's the realization spreading through the system that the paper bets no longer match the physical reality. Because this rally isn't being driven by Reddit traders clicking buy the dip. That era is over. The bid has shifted upstream toward industrial users, sovereign buyers, and institutions that don't flinch at headlines or margin hikes. If you panicked and sold into the drop, you didn't escape the damage. You became the liquidity. You were the fuel. But if you understood the setup, you're watching something rare unfold in real time. This isn't a prediction. It's a signal, and it's one of the most important the market has sent in years. What happened overnight wasn't noise. It was the market telling you the crash failed, and the squeeze has already begun. What you just witnessed was not chaos. It was choreography. This is where most people get it wrong. They think the drop was random. They think the market got scared. That narrative is comfortable, and it's completely false. What happened was a textbook bear trap, executed with precision, timing, and intent. The first clue was location. The sell-off didn't happen anywhere. It stopped exactly where it needed to. Between $60 and $62, that zone wasn't chosen by accident. It was a minefield of stop-loss orders. Thousands of retail traders had their automatic sell buttons parked right there, convinced they were being disciplined. In reality, they were predictable. The banks know this. They always do. To get liquidity, they don't ask politely, they force it. So they needed a trigger, a catalyst, something that looked legitimate enough to justify panic, a margin hike, a scary headline, a regulatory excuse, just enough pressure to shove price down into that stop zone. And the moment it hit, the machine went live. Snap. Stops fired in waves. Retail sold automatically. Red candles printed fast and ugly. Fear spread. That fear did the next part of the job for them. Bears piled in. Shorts came rushing, convinced the trend had finally broken. Bets were placed aggressively that silver was heading back to 50. That's when the trap closed, because the selling you saw wasn't exit selling. It was inventory creation. The banks weren't dumping risk. They were manufacturing it. They pushed price down to trigger volume, then quietly absorbed every contract that hit the tape. From panicked sellers, from overconfident shorts, from anyone willing to give them metal at a discount. Once their bags were full, they stepped away. And that's when reality reasserted itself. Natural demand snapped back like a coiled spring. With the artificial pressure gone, price didn't crawl higher. It ripped. Overnight gaps erased the entire drop in a single session. Sellers were left holding cash they didn't want. Shorts were instantly underwater. Forced buying kicked in, covering Fed momentum. Momentum fed price. That violent V-shaped recovery wasn't a coincidence. Weak markets don't do that. Fake crashes do. The drop was engineered. The recovery was organic. And once you see that difference, you can't unsee it. Now the question isn't what happened. It's why it worked so perfectly this time. Now we get to the part that scares them the most. Because this was supposed to work, they've used this weapon before. And for decades, it never failed. Raise margin requirements sharply, force traders to post more cash, make holding positions painful. In 2011, it was devastating. Margins were hiked repeatedly, and silver collapsed nearly 30% in a matter of days. Speculators were wiped out, leverage evaporated. The bull market was broken for a decade. That memory still lives in the system. And the banks were counting on it working again. But this time, the blast didn't knock the market down, it got absorbed. And that's the tell. At first, it looked familiar. Prices dipped, screens flashed red, commentators declared victory. But then something happened that wasn't supposed to happen. The selling stalled. The bids didn't disappear, they thickened. The market didn't unravel, it steadied itself, shook, and stood its ground. A margin nuke that fails to cause a crash is not neutral. It's bullish. And the reason why cuts straight to the structure of the market, this is where the real shift reveals itself. In 2011, silver was owned by weak hands, fast money, hot money, traders running 20 times leverage who had no choice when the margin call hit. They didn't sell because they wanted to. They sold because they had to. Today, those players are no longer in control. The market is owned by entities that don't blink. Industrial users, family offices, sovereign wealth funds. These aren't bets, these are necessities, supply chains, long-term protection. When told to post more capital, they didn't liquidate. They wired the cash. That single behavior change flips the entire playbook because these buyers are not price sensitive. They don't care if silver is 60 or 63. They care about tonnage, availability, certainty of supply. They measure risk in shortages, not headlines. So when margins rose, instead of triggering forced selling, the market discovered something uncomfortable. The buyers weren't leaving, they were digging in. That's not resistance, that's resolve. And it changes everything. This is why the margin nuke backfired. The banks assumed the old pain threshold still applied. They assumed a big enough hike would break the bull's back. Instead, it barely annoyed it. Markets that ignore bad news are sending a message. They're saying supply matters more than policy, volume matters more than price, and control has already slipped away. When the ultimate weapon fails, there isn't a backup plan. There's only exposure. And that failure didn't just protect the market, it set the stage for what came next. Once the margin weapon failed, the market shifted to a different battlefield. Not balance sheets, not regulations, human psychology. This is where the real damage happens. A V-shaped recovery is not just a chart pattern. It's a psychological weapon. It's what turns fear into regret, and regret into forced action. Think about the trader who sold at the bottom. Friday night. He felt smart. He saw the red candles. He saw the margin hike. He told himself he was being disciplined. He sold to wait for lower. He went to sleep calm. Then Monday morning arrived. Silver wasn't lower. It was higher than where he sold. Instantly. Violently. No chance to react. No slow climb back in. His cash didn't protect him. It stranded him. And now he's facing a choice most people hate to confront. Admit he was wrong and buy back higher. Or wait and hope for another crash that may never come. Most people choose denial. And denial is expensive. As price keeps moving, regret compounds. 65, 68, 70. Every dollar higher feels personal. The loss isn't just money anymore. It's missed opportunity, identity, ego. That regret slowly mutates into FOMO. And when it finally breaks, it doesn't break quietly. It breaks at the worst possible time. That's how people end up buying tops. Not because they're greedy, because they're desperate to escape the pain of being left behind. This is how bubbles are built. And it starts with one V-shaped recovery. But there's another layer to this move. The shakeout, that violent drop didn't just scare people. It cleansed the market. Weak hands were removed. Excess leverage was flushed. Overcrowded optimism was reset without breaking the trend. What looked like damage was actually preparation. The train got lighter, and a lighter train moves faster. This is why strong trends accelerate after shakeouts, because the passengers who panic don't get back on easily. Now zoom out and ask the harder question. What outcome causes the most pain to the most people? Markets are cruel like that. They don't move toward fairness. They move toward maximum discomfort. A slow grind higher doesn't hurt enough. A crash doesn't generate selling from true believers, but a relentless rally after a fake breakdown that punishes everyone. Shorts, sellers, sideline cash. Professionals who hesitated, that is the max pain trade. And it's exactly where this market is drifting. The failed margin nuke proved supply was tight. The bear trap exposed positioning. Now psychology is doing the rest of the work. And once a market enters this phase, it doesn't ask for permission. It forces participation. The only question left is who's already positioned and who's about to be chased in. Up to this point, everything could still be dismissed as psychology, fear, regret, FOMO, crowd behavior. That excuse ended when London opened, because for 40 years, London played one role and one role only. It was the seller of last resort. When prices ran too hot, London cooled them down. When New York panicked and bought aggressively, London supplied the metal calmly, methodically, relentlessly. The London Bullion Market Association wasn't just a marketplace. It was the pressure valve, the control room, the place where rallies went to die. That's why what happened next matters so much. When the UK market opened, London didn't sell. London panic bought. Aggressive bids hit the tape immediately. Not passive orders, not price-sensitive nibbling, real size, real urgency. The kind of buying you don't see unless something has gone very wrong behind the scenes. This was a change in character, a structural shift. It was like watching a firefighter show up to a blaze and start pouring gasoline instead of water. That's not confusion, that's desperation. This is where the story leaves retail behind. Reddit doesn't do this. Momentum traders don't do this. This was bullion banks, LBMA participants, institutions that have spent decades suppressing volatility, suddenly chasing price higher. And banks don't flip sides because they've changed their beliefs. They flip because their risk has changed. Banks don't have ideology. They have liabilities. So why did they switch? Why would the historical seller of last resort become the buyer of first resort? Because one number they watch more closely than price itself started flashing red, and the public almost never sees it. Availability, not inventory. Availability. There's a difference. Inventory is what exists in vaults. Availability is what can actually be sold. And when London looked into the system to do what it always does, lean on supply, it found something terrifying. The cupboard was bare. The metal that usually shows up on command wasn't there. The pressure valve was empty. That's when panic replaces strategy, because if London can't supply, it has to secure immediately, at any price. And that buying isn't speculative, it's defensive, it's balance sheet driven, it's survival behavior. Once that starts, price is no longer the signal, it's the consequence. This is why the pivot matters. It proves the shortage is real. Up until now, skeptics could argue sentiment, they can't argue London. When the most powerful suppression hub in the precious metals market switches sides, the game changes, the bear trap set the stage, psychology did the cleanup, but London pulling the trigger is confirmation. And what forced that pivot is the most dangerous word in this market, the float. This is where the story stops being an opinion and starts becoming a constraint, because everything up to now leads to one misunderstood word, the float. Most people hear inventory and think supply. That's the first mistake. Inventory is what exists on paper, what's counted in vault reports, what gets quoted in headlines. The float is something else entirely. The float is what's actually available for sale, what can be delivered, what can be sourced right now without forcing someone to give it up. That's why the 800 million ounces sitting in London don't mean what people think they mean. That number is real, and it's deeply misleading, because that pile of metal is an iceberg, and 85 to 90% of it is frozen solid, owned by ETFs, locked by sovereign wealth funds, parked by family offices who vaulted it years ago and threw away the key. That silver does not trade. It does not respond to price. It is strategic inventory. It might as well not exist. What actually sets the price is the float, the unallocated metal, the dealer pot, the bars that can be leased, shipped, refined, or delivered to industry. And over the last 3 years, that float has been quietly drained, not by headlines, by demand. India didn't buy ETF shares. It bought metal, tonnage by tonnage, shipment by shipment. The dealer pot was emptied while everyone was watching the wrong number. That's how shortages form without warning. Now add the leasing market. This is the hidden end-to-end engine that made the illusion work for decades. Bullion banks lease silver out to industrial users, refineries, electronics manufacturers, energy supply chains. The user consumes the metal and promises to return it later. That system creates virtual supply. The same ounce can be counted multiple times, as long as it comes back. But what happens when it doesn't? What happens when silver gets turned into solar panels, batteries, or defense systems? It's gone. It can't be returned. And when replacement metal can't be sourced, the lease breaks, lease rates spike. That's not noise. That's the market screaming shortage. And that scream has started. Now, layer in unallocated accounts. For decades, banks ran a fractional system. 100 ounces of real metal backing 500 ounces of claims. It worked because no one asked for delivery at the same time, until fear changed behavior. Family offices looked at the volatility, looked at the headlines, and said one sentence that changes everything. I want my bars. When unallocated becomes allocated, metal leaves the float permanently. If even a fraction of clients demand segregation, the math collapses. Banks don't hedge this risk. They scramble, they rush into the spot market and buy physical silver at any price available. Not to speculate, to survive. That's a bank run, just quieter. This is why London panicked. This is why buying became urgent. And this is why price stopped being the question. When the float is gone, price is no longer a negotiation. It's a signal asking one thing: who is willing to sell? When supply breaks, price looks for the next pressure point. Right now, that point is 65. Silver is trading in the low 60s, 63, 64. This zone matters. But it's not the battlefield. The real fight is directly overhead. $65 is not just a number on a chart, it's a liability threshold. And once price gets close, the mechanics of the market start to turn against the people who thought they were in control. Here's why. In the options market, there is a massive concentration of call options at the 65 strike for the near-term contracts. Millions of ounces tied to one level. Those options were sold by market makers, banks, dealers. But if silver stays below 65, they win. The options expire worthless. Premium collected, risk avoided. But if price breaks above 65, the script flips instantly. As silver approaches that level, market makers can't sit still. Their risk models force action. This is called delta hedging. To protect themselves, they must buy silver futures as price rises. Not because they want exposure, because they're required to reduce it. The closer price gets to 65, the more they're forced to buy. And here's the trap. Their buying pushes price higher. That feedback loop is called a gamma squeeze. Buying creates more buying. Neutral players become forced participants. Defenders turn into fuel. It's what happened in GameStop. It's what happened in Tesla. And it's sitting dormant in silver right now, waiting for confirmation. Above 65, resistance doesn't thicken. It disappears. That's why volatility will spike just below that level. Expect whipsaws around 64.80, 64.90. Paper will be dumped. Stops will be hunted. Anything to hold the line. But if physical demand from London and Asia keeps pressing, that wall won't bend. It will break. And once it does, price won't crawl. It will vacuum higher. Now layer in timing. The US market is about to open. This is usually where rallies die. Asia buys, London buys, New York sells, the 10 a.m. smash. It's been reliable for years, but today is different. Americans are waking up to a green chart, to the same headlines that panicked London. And American capital is momentum driven. When they see silver up hard overnight, they don't think late. They think missed. That's FOMO entering the ETF complex. Fresh cash hitting vehicles that must buy physical metal to match inflows. That demand stacks on top of an already strained system. The only counterforce is the dollar. And if the dollar defense fails to reverse price early, shorts are in serious trouble. Watch volume. It will tell you who's winning. One more signal matters now. Mining stocks, they were crushed on the drop. They lag at turning points, but math always catches up. If silver holds these levels, miners have to reprice. That catch-up trade is fast and violent when it starts. And it often starts right when most people hesitate. The float is gone, the gamma wall is shaking, and the next 24 hours decide who chases and who's already seated. Now, zoom all the way out. This isn't about today's candle or tomorrow's headline. It's about where we are in the cycle. We're in late December, year-end, the moment Wall Street cares more about appearances than prices. This is when window dressing kicks in. Funds that ignored silver at 30, 40, even 50 are suddenly forced to own it at 60 plus. Not because they believe, but because they can't afford not to be seen owning the winner. That's the pain trade. Ask the question markets always ask. What outcome hurts the most people? A crash back to 50 doesn't do it. Long-term holders don't sell. Supply tightens. No liquidity appears, but a relentless push higher that hurts everyone who hesitated. Banks short physical, industries dependent on silver, cash holders watching inflation eat them alive, professionals underweight the one asset they can't explain away anymore. That's why this move matters. For 40 years. Wealth flowed from real things to paper claims. From metal to derivatives, from production to promises. That tide is reversing. You can't print silver, you can't email a solar panel. The physical world is reasserting its value. But here's the warning. Winning phases are violent. Volatility expands. $2 swings become 5. 5 become 10. Weak hands don't survive trends like this. Leverage doesn't survive. Attention doesn't survive. The strategy stays simple. Own what's real, reduce noise, let the forced buyers chase. This market isn't asking for belief anymore. It's demanding positioning. If you're still here, you didn't get lucky. You stayed seated while others jumped off. That's what Star Diamond Hands really means.